ledger accounts and double entry bookkeeping. So we need to understand some few things before we go to the main area. In this case, one, we need to understand what is a ledger. Then from there, we need to understand what are the ledger accounts. Then from there now, we can talk about the double entry bookkeeping. Ledger. A ledger, it is simply a book. This is simply a book. We all know what is a book. A book has got pages. So a ledger is a book that is specifically designed to record transactions as they occur in the business. So it is a book. And we have got different types of ledgers here, whereby number one, we have got a ledger we call the sales ledger. The sales ledger. Number two, we have got a ledger book we call the purchases. And then number three, we have got the general ledger. So let me explain each one of them. Starting with the sales ledger. What is a sales ledger? But from the onset, I want you to understand that a ledger is a book. So we have got three different books. One of them is known as the sales ledger. So a sales ledger, it is a book that is only going to contain the accounts for credit customers. We only record here the transaction relating to credit customers, who are also referred as the debtors. So we have the accounts of the debtors or the credit customers. Anytime a customer buys goods on credit from our business, we need to go and open an account for that customer in the sales ledger. So the moment I'm presented with a sales ledger, I will automatically know that the accounts that are in that particular sales ledger are purely the credit customers. Those customers who bought goods from business, they never paid for those goods. They will pay for them at a later date. All of them, I'm going to find them in the sales ledger. So maybe page one, I will find the account for John. Page two, I will find for Maria. Page three for Fatuma, Catherine, and so on and so forth, up to the last person. All of them. So when they buy, we record them there. So at a given point they are going to pay, we still adjust the account from the sales ledger. So it is purely meant to record accounts related to credit customers. Then we have this ledger book we call the purchases ledger. A purchases ledger, it is a book that is only going to record accounts for the credit suppliers. It's going to contain the accounts for credit suppliers, also known as the creditors. Anytime we buy goods from our suppliers on credit terms, then we need to come and open an account for that particular supplier in a book called the purchases ledger. So it is just the same case here, but only that here we are talking about credit purchases. We buy, we record them in the purchases ledger. So the moment I'm given the purchases ledger book, I'll just know that the accounts that are going to be contained in that purchases ledger book, it is only for the credit suppliers. Those suppliers who supplied the goods to us on credit, we never paid them, we shall pay them at a later date. All of them, I'm going to find them in the purchases ledger. So each page of the purchases ledger will contain an account for a particular supplier. Each page, maybe page one, it is for XYZ Limited. Page two, ABC Limited. Page three, Amani Wholesalers, and so on and so forth. Only the credit purchases or the credit suppliers are going to be contained in the purchases ledger. So at this point, I want you to note that the ledger is a book. Every page of the ledger is an account for a particular entity. Either if it is the sales ledger, every page is going to contain an account for a particular credit customer. If it is purchases ledger, every page of the purchases ledger is going to contain the name of a particular credit supplier. Then all the other accounts which are not related to debtors or the credit customers or creditors who are the credit supplier, all the others now are normally maintained in a ledger book known as the general ledger. The general ledger. Here, we record items like the capital, we record items like the non-current or what we call the fixed assets. We record items related to expenses, revenues, etc. All those other accounts which are not related to credit customers or credit suppliers, they are known as, or they are going to be maintained in the general ledger. They are going to be maintained in the general ledger. So that is basically what ledger is. A ledger is a book, and each book is designed for a particular class of accounts. And there are 3 in number. The sales ledger, meant for credit customers, the purchases ledger, meant for credit suppliers, and then the general ledger, which records all the other category of accounts which are not related to debtors or creditors in any way. So that is it about the ledger. Having understood now that a ledger is a book in which we are going to have the accounts, now I can talk about ledger account. A ledger account, it is actually a document, or I can say something that is designed for a particular format that is meant to capture the details of all the transactions as they occur. So as the transactions occur, they are normally recorded in the ledger accounts. These ledger accounts are the ones now that are going to be contained in the ledger. So a ledger is a book containing pages. Each page of the ledger is a ledger account. It's a ledger account. So a ledger account is going to be of this form. Maybe you have seen it like this. This is the page of a book. Then that page will be divided into 2, like that.
Excuse me, Malim.
Yes.
Please, I'm sorry to just take you back. Are we still talking about the books of original entry, or we've moved to ledger accounts? That's a different one.
Now we are in the ledger accounts. We are done with the books of original entry. So remember, we said that the books of original entry, that is where a transaction is first recorded.
Yeah.
The moment it is recorded there now, it is going to be transferred to ledger accounts. It is going to be transferred to ledger accounts. These ledger accounts are going to be contained in the ledgers. So each and every page of a ledger book is going to be a ledger account. And that page is going to be divided into 2 like this. So that is a page, maybe it was page number 1 for a particular account. So the right-hand side, we normally call it the credit, and the left-hand side, we normally call it the debit, like that. This is the debit side. This is the credit side. So a ledger account, it is a page of the ledger book. And each account, it is going to have 2 identical parts. One part is to the right, which is known as the credit side, and there is another side which is to the left, which is known as the debit side. That is how a ledger accounts look like. But before we go further, we need now to talk about the classification of ledger accounts. Classification of ledger accounts. They are broadly classified into 2. So we have got the ledger accounts here, which are classified into 2. We have got those that we refer as personal accounts. And here we have got those we call impersonal accounts. So that is the first classification. Ledger accounts can be categorized as personal or impersonal. Personal accounts, they contain the names. They contain the names of persons or organizations. They contain the name of persons or organizations. And these personal accounts, they are simply the debtors and creditors accounts. The debtors and the creditors accounts, they are categorized as personal accounts. The reason as to why they are known as personal accounts, it is because these accounts, they are going to contain the name of a person. Like for example, if this was an account, maybe it is an account for Mary, who was our credit customer. So we have written the name of a person there. So the moment it contains the name of a person, then it becomes a personal account. The same case, instead of Mary account, we can have maybe ABC Limited, ABC Limited account. This is the name of an organization. This is the name of an organization. Maybe it is our supplier. So the moment it has either a name of a person or a name of a business organization, that account is normally considered to be a personal account. And these two, the debtors and the creditors, they are the ones that contains the name of the person. The name of the person for the debtors, it is the person to whom we sold the goods on credit. If it is a creditor, it is a person or business organization from whom we acquired goods on credit. So either way, either the debtors or the creditors, they are going to contain the names of persons or business organizations, and therefore they are considered as personal accounts. Under the personal, we have got two more classifications. We have got those accounts we refer as real, and then we have got those that we refer as nominal. Nominal accounts, these ones are real accounts. For the real accounts, this is an account for real items that we can be able to see and even touch. In short, items that we can be able to see. They include, e.g., something we call fixed assets. Fixed assets, those assets that are going to be in the business for a long period of time, more than one financial year. They include motor vehicles, machines, computers, furniture, machineries. All those are known as fixed assets. We don't buy them with the intention of selling them. We only buy them to assist us in running the business. So these items are real. We can be able to see them. They also include things like inventory or stock. They include also things like the cash. All those are considered as real accounts. So if, for example, you have a furniture account is a real account because furniture is something that is real. If we have got inventory, that is also a real account and something like that. Sorry. If we have computer account, that is also a real account because those are things that we can be able to see. Then the nominal account, they are for those items that are not real. We call them non-real or intangible items. The non-real or what we call the intangible items, things that are just there by imagination. So like, for example, when we say rent account is not something that we can be able to see. E.g., that we just categorize them as all the expenses account. The rent, the insurance, repairs, and all those, they fall under the nominal accounts. We also have something like the capital account. Capital account is a nominal account. We have got the purchases account, the sales. All those are considered as nominal. So to summarize everything, ledger accounts are broadly classified into two. They are broadly classified into two. Just a minute, kindly. Hello. 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 Just a minute, there's somebody who is having some difficulties in joining. Let me sort him out. So we are now in agreement, or we have a clue that we have got a ledger, which is a book. We have got ledger accounts, which are pages of that particular book. And each ledger is going to have a separate class of accounts to maintain. Having understood that, and now we have talked about that the ledger accounts, they are either personal or impersonal, whereby personal ledger accounts are those accounts that only capture the name of persons or business organizations. Impersonal accounts, they normally capture information of items that are not either a human being or a business organization. And on that basis, impersonal accounts can also be referred as real or the nominal. The real accounts for those items that we can be able to see. The nominal accounts are those accounts for items that we cannot be able to see. Before I go now to the double entry concept, allow me to briefly talk about what we call the accounting equation. Allow me to talk about accounting equation briefly. Accounting equation, it is
Excuse
actually...
me, Mwalimu.
Yes?
Excuse me, Mwalimu. I have a question.
Yes, kindly.
On real accounts,
Yes.
you've given an example of cash as a fixed asset, and on nominal account, you've also given as sales. What is the difference?
Okay, let me clarify there. Cash is not a fixed asset. When I was giving examples of real accounts, I said that under the real accounts, we have got the fixed assets. And under the fixed asset, I explained these are items that are going to be used in the business for a long period of time. Actually, we acquired them with no intention of selling them. Those items that you buy to be assisting you in running the business, like the computers, the motor vehicles, the equipment, the machineries, the furniture, and so on and so on. All those are normally considered as fixed assets. They will be in the business for a long period of time. But the real thing or the fact is that those are items that we can be able to see. Then I also talked about inventory as an example of a real item, and also the cash. When you are given the coins and the notes, those are the things that are tangible. So they are real. So, and then on the other side, when I was talking about the impersonal, sorry, not impersonal, but the nominal accounts are for those items which are intangible. And I gave here an example of sales, as when we talk about sales account. Now, you can ask a question at that point so that now I can respond. What was the difference between cash and sales? I think I had something like that. Cash.
I've gotten the...
You have gotten the concept, eh?
Yes, I have.
Yes.
Thank you.
Yeah. So cash, it is simply the notes and the coins. The sales, it is an account that we normally maintain to record the value of goods that you have sold. So if today I sell some goods, I am going to record them under the sales account. And then we shall see actually those goods can be sold and then we receive cash. So we are going to discuss that one in detail when we get to the double entry concept. So,
Mwalimu, could I ask something as well?
Yes, you can.
Okay, sorry to take you back. Where you divided the ledger account into a personal account has the name of a person or an organization. What about the impersonal?
Impersonal now, that is where we have the real and the nominal. The real and the nominal accounts are impersonal because they are not meant for an individual or a business organization. So it is impersonal, meaning that it is either a real account for a particular item that you can be able to see, or as a particular item that exists, but those items are not tangible like the expenses. So intangible or impersonal accounts are the accounts for real and nominal accounts combined. Is that okay?
But if the description says that a car belongs to a certain person, let's say a motor vehicle belongs to Mr. John.
Yes.
So would that be, it's a vehicle, but it belongs to someone. Is that a personal item then, or is that going to go to where the real accounts are?
Oh, it is going.
If you're given a value, maybe I'm given a value of a vehicle belonging to someone.
Yes. You are given the value of a vehicle. That vehicle is a real item. So it is an impersonal because it does not go there. Actually, we don't, in the business, we don't capture it using the name of the business owner. We normally use or capture each and every item under its own heading, under its own headings.
All right.
That's all. So if it is a motor vehicle, we shall have motor vehicle account. So that motor vehicle account is a real account. Anybody with a question or needs a clarification? And then our class rep for the curriculum, there is one of us, Winnie. Kindly share with her the link for the WhatsApp group so that she can also be getting the information. So the accounting equation. The accounting equation is simply an expression that relates two parts. On one side, we have got these items in the business that we normally refer as the assets. Assets are those resources that are owned by the business. Those resources that are owned by the business. In short, in this class, we shall be putting ourselves in the shoes of the business owner. The business is ours. All those resources that we can point and say that this and this and this and this are ours, all those resources are considered to be assets. They are considered to be assets. So assets in a business, they are normally acquired using two options. You either acquire an asset using the amount of money that you invested in the business, and that amount is normally referred as capital, or you can acquire an asset on credit terms. When you acquire it on credit terms, then you are going to create what we call what? Liabilities. Let me go back a bit. Assets, those are the resources that we own as a business, and these are the resources that we use in generating income in our business. Anything that we can say that it is ours, it is an asset. Those assets, you can acquire them using two options. Either you buy them and you pay for them using the resources that belongs to the business, which is capital, or you can acquire an asset in the business and you pay for that asset later. When you acquire an asset and you are going to pay for it later, you will have created what we call liabilities, and liabilities are simply debts. So the resources that are owned by the business, that is now according to the accounting equation, the the resources that are owned by a business, they are going to be equal to the amount of capital that was invested in that business plus all the debts that we owe outsiders. So if we combine these two, if we add the value of capital and the value of all the liabilities that we owe the outsiders, if we combine them, they should be equal to the value of assets that we own in the business. They should be equal to the value of assets that we own in the business, which makes sense. Because unless it is a charitable organization, whereby we get the donations and such kind of things, if it is a profit-making business, the resources that are going to be owned by that business, they are going to be either financed by the capital, which is what the owners contributed, or the liabilities that we have created. Yes, we can buy a motor vehicle, but we don't pay for it, but we buy it on credit, so that is a liability. So that debt that we owe that particular owner of the car is now equivalent to the value of assets that we have acquired. So if I acquire an asset of 2 million on credit, I'm going to have 2 million liability. At the same time, I'm going to acquire 2 million assets. So you'll find that they will balance. If I buy, like for example, a computer worth 30K, that is going to be an asset in the business because it is a resource that I have acquired. But at the same time, I will have used my capital of 30K to purchase it. So at any given point, the resources that we own is, or they are going to be equal to the liabilities. They are going to be equal to the liabilities that the business owes the outsiders. That is generally the accounting equation. So if you are told to explain the meaning of the accounting equation, you just say that it is an equation that explains that the resources owned by the business, into bracket assets, they should always be equal to the resources invested by the owners, into bracket capital, plus the borrowed resources, which are now going to be liabilities, After having understood that, then we need to come here and say, these assets that a business is going to own, they are of what categories? The assets the business is going to own, they are classified as fixed. Into bracket, we also refer to them as non-current assets. That is the first category of assets that we have, fixed or non-current assets. When we shall be progressing with the unit, we shall be referring to them as non-current assets. They used to be called the fixed, but nowadays the accounting standards refer to them as non-current assets. Non-current asset, this is an asset the business acquired, and that asset was acquired with no intention of selling it in the near future. Actually, it was acquired with the aim of assisting in running the business or making the running of the business smooth. So they include things like the motor vehicles, the furnitures, we have got the equipment, we have got the computers, anything that we can have in our business. We are not actually having any intention of selling it. It is there to assist us in running the business. And the most important characteristic of the non-current assets is that they will serve the business organization for a period exceeding 1 financial year. They will serve the organization for a period exceeding 1 financial year. So we shall be using them. After 1 year, we end the year. When we start a new year, those assets are still there, assisting us in running the business organization. Then we have got the second category of assets, which we refer as the current assets. For the current assets, these are the resources that we have, but they are not going to remain in the business for a long period of time. In most cases, they are going to remain in the business for less than a financial year, for less than 12 months. We don't have them anymore. They are already left the business. A good example here is the inventory. inventory or stock, you buy it with the intention of selling it within the shortest time period. The cash in hand and cash at bank. It is another current asset. We also have these people we call the debtors. These are people with our money because they bought those goods on credit. These are simply the credit customers. They have resources that belong to the business. Those resources, because they belong to the business, it is an asset to us. We also have what we call the prepaid expenses. The prepaid expenses. Prepaid expenses are those expenses that we pay in excess before the actual date of paying. If, for example, you have paid your school fees in excess, such that in this semester you are supposed to pay maybe 40,000, but you have paid 45,000. The 5,000 on top, it is going to be considered as prepaid. When it is an expense, it simply means that you have paid more. The more or the extra or the excess that you have paid is still your money until you receive the services. So it is an asset to the business. It is an asset.
Mwalimu, this is prepaid expenses are still part of current assets, right?
Yes, they are still part of the current assets.
Okay.
Still part of current assets. So those are the assets. The assets, just know that it is anything that we can call ours as a business. Anything that we can simply point and say this is ours. We have the ownership rights. It is an asset. And they can be either non-current or current. And current here, we also have the land and the buildings. The land and buildings, commonly known as the premises, they are also part of the non-current assets. Then, having understood what assets are, we can briefly talk about capital. Capital, it is what the owner or the owners have contributed towards the business. Remember, we cannot have any business without capital. The owner must have contributed a certain amount of money towards starting the business. That amount that the owner contributed towards starting the business is what we refer as capital. So capital here, it is also known as the owner's equity. The owner's equity, what the owners brought to the business to start it. If this capital was not pumped into the business will not be existing. So the owner's equity is what we call capital. What the owners have brought to the business, make sure that the business starts and runs. Then we have got what we call liabilities. And anytime the word liability is mentioned, just know they are business debts. Not personal debts, but business debts. Any borrowing the business has done is considered to be a liability. And these liabilities, they can either be long-term, a long-term liability, it is a liability that is payable after a period exceeding one financial year. So if we borrow something, either money or an asset, and then we shall pay for it after a period more than a year, it is considered as a long-term liability. Here we have got the bank loan. The bank loans, the long-term bank loan, it is a long-term liability. Then we have got what we call the current liabilities. Current liabilities or current debts. They are those debts that are payable within a short period of time, and actually they are not supposed to be paid after more than a year. Those debts that we have created as a business, but we are going to pay them within a very short period of time. They are known as current liabilities, e.g. creditors, e.g. the creditors or accounts payables. This, remember, I've just been talking about creditors and debtors. And by now, I hope you can now be able to differentiate between the two. The creditors, it is amount we owe the suppliers. The amount that we owe our suppliers. We bought goods on credit from them, but we have not paid them. So those people from whom we acquired the goods on credit, they are known as the creditors. They are known as the creditors. Whereas the debtors are our customers We sold goods to them on credit, so they have our money. That is why we call them assets. But in this case, we owe them. We owe them. So it is a current liability. We also have what we call the bank overdraft. The moment our bank allows us to withdraw more than what we have in our bank account, then we find that our bank account has gone negative. That negative bank balance is what we refer as the bank overdraft. In most cases, the overdraft is supposed to be cleared within a period of 3 months. So it falls under the current liability because it is less than a year. We also have now what we call the accrued or outstanding expenses. Those expenses that we have not paid by the time the year comes to an end. The expenses that we have not paid by the time the year comes to an end, they are known as accrued or outstanding expenses. If the year ends today, but we have not paid the salaries to our employees, that salary now becomes accrued salary, and it's going to be considered as a liability because the payment period is already due. The payment period is already due. So that is what you need to understand. So anytime we say that assets are equal to capital and liability, just to know that the value of assets that we have, it is actually the sum of capital that we invested plus the liabilities that we have created as a business. And at any given point, whenever any transaction occurs in a business, you will find that this equation will continue or will still remain. You buy something, you have acquired an asset, you have spent either your capital or money that you had in the business, or you have created a liability. At any given point, this equation will always balance. That equation will always balance. But don't forget that when you are given this equation that A is equal to C plus F, that is assets is equal to capital plus liability. Don't forget that from this equation, we can generate 2 more equations depending on the letters that we want to make the subject of the equation. We can simply, maybe at some point, be interested in determining the amount of capital. If we need to find the value of capital, R will come to this side. So we are going to have A minus R is equal to capital. A minus R is equal to capital, and R is equal to, if we want to get R here, C will come to the other side. So we are going to have A minus C equals to R. So these 2 equations can be derived from the mother equation. Can be derived from the mother equation. Any question up to that point? Any question up to that point?
Question, please.
Yes, ask.
If I withdraw money, if I borrow money from my business for personal usage with the promise of paying it back, or maybe with interest, how do you treat that?
Taking money from the business for personal use. At the point of taking the money, that amount, we normally say that you have done drawings. When you take money for your own personal use, at that point of taking the money, you normally say that you have done drawings. So what will happen is this: cash will have reduced. You know, we have got 2 here. We have got cash account or bank, for that matter, if you withdraw from the bank, and we have the drawings account on the other side. This account, we are going to debit there, and this one we are going to credit at the point of taking the money from your business. If you take it today, then today you need to open the drawings account, you debit because the money has gone out, and then you credit cash because actually money has reduced. Then when you shall bring your money back, if you decide now after a week you are going to bring that money back, we are now going to come here and debit this. Either cash or bank is going to be debited. When you are paying back the business, we debit cash or bank because you are going to bring money in form of cash, or maybe you are going to write a check. If you are going to bring it in form of cash, cash will increase. So we normally debit it. If you are going to write a check and then deposit in the business bank account, then bank is going to increase, so we are going to debit. So I want you maybe to understand it here now that cash or any other asset, whenever it is being received in the business, we normally debit. Any asset, be it current or non-current asset, when it is being received in the business, we normally debit. But when it is moving out of the business, we normally credit. That's why here I said that we are going to credit cash or bank when you are taking money for your own personal use, because that asset is reducing, we shall be crediting one of the two. But when you bring it back now, we are going to debit the cash or bank because it is going to be received. Then we are going to credit what we call capital. We are going to credit what we call capital, because it's like now, when you are taking that money, we normally debit the drawings, but drawing simply means that capital has gone out. But when now you bring that money back, we shall be debiting capital, crediting capital, sorry, and then debit cash or bank. But practically, we are going to do it here. I hope I've tried to explain. I know it can be a bit challenging now that we have not done a double entry, but that is the procedure. Anytime an asset is moving out or reducing from the business, we credit. But when that asset is being received, we debit that asset. And that's where we are heading next. Have I tried to answer your question?
Yes.
Yes. Okay. Okay. Now we go to the main business of the day, the double entry bookkeeping. Double entry. Actually, we normally call it the golden rule of accounting. The golden rule of accounting is what we call the double entry, also known as the dual aspect concept. It is the golden rule in accounting. Everything in accounting starts and ends with double entry. Everything in accounting starts and ends with double entry, the double entry or the dual aspect. And the moment you are able to understand this double entry, you realize that the subsequent topics are going to be very, very simple for you. But if you have got some challenges with the double entry, you might find some challenges in the subsequent topics, because all of them are going to be coming back double entry in one way or another. From the word double entry, or from the word double, it simply means that any business transaction that occurs, it must have a double or dual kind of, it is going to have double or dual effect, the double or dual effect, in the sense that it is going to affect two items. It is going to affect two items. Those two items, one of them is going to be recorded on the debit side, and the other one is going to be recorded on the credit side, depending on the category the items belong to. I want to give a very simple, maybe, illustration. Suppose I sell this mark pen. I sell this mark pen for 50 shillings. We are going to have two effects on that. One, as an individual, I'm going to lose this particular pen. I'm not going to have it anymore because I've sold it. But at the same time, I have received 50 shillings. At the same time, I have received 50 shillings. So we have got two things that are happening there. I'm losing my pen, but at the same time, I'm receiving some cash. That is what we are talking about as double entry. So in the ledger accounts, I will be required to capture the two entries. Capture the first entry that I have lost a pen. Then capture the second one and say that I have received cash. So any business transaction, and remember, a business transaction is a transaction that has monetary value. it has some monetary effect. It must have or measured, it must be measured in terms of money. So any transaction that can be measured in terms of money, we normally call it a business transaction. That transaction will have two effects or will affect two items. One of those items is going to be recorded on the debit side and the other one on the credit side. And all this recording is going to take place in what we call the ledger. Ledger accounts, the standard ledger accounts has got the following columns: the date, the details, and the amount. The same are repeated on the other side: the date, the details, and amount. From where I have my double lines to the left, this is the side we are talking about in debit side. We normally abbreviate by DR. From where I have my double lines to the right, that side we normally refer it to credit, which is normally denoted by CR. Then we are going to have the name of the account. Name of account. Account, we are going to abbreviate it with A/C. Anywhere you see A/C is a account. So I was giving an example of this mark pen of mine, and I want to dispose it. The moment I want to dispose it, I will be required to draw two accounts. I will be required to draw two accounts. But the good thing, this being the standard ledger account, we normally have a simplified version account. The simplified version of account is a capital T. Normally have it like that as a very big capital T. So this side is the debit, this side is the credit. So any transaction that happens, we are going to draw two accounts. So in this case, I will have an account here, record the sale of this particular pen. This one I can come here and I call it the pen account. I can come here and call this one cash account. I want to record that I have given out the pen and also record that I have received cash. So in that case, this is my asset. This is an asset to me because it is something that I own. This is something that I own. So whenever you dispose or you give out an asset, the assets are normally credited. Assets are normally credited when you are giving out. But when you are receiving an asset, you debit. So in this case, I will come here and record that cash is an asset to me because it is money that I own. So anytime I receive cash, I record it on this side, on the DR or the debit side, because it is an increase in that asset being cash. The cash that I had, if I had 50 shillings in the cash box, I said this one and I received 50. So I'm going to increase the cash box from 50 to 100. So I'll come here and just say, like, for example, I have received money from the pen, 50. The pen account, what has happened to the pen? I have lost the pen. I have lost the pen. I will come on the other side now and record that this pen is now going out. It is no longer in the business, and say that I have sold it by cash, 50. Anytime an asset account is debited, it simply means that it is a receipt. You are receiving that asset. So in simple terms, in the cash account, because it's on the debit, simply means that I have received 50 from the sale of pen. On the other side, when I credit an asset, it simply means that that asset is actually being given out. So when I credit the pen account, it simply means that the pen is moving out, and as a result of it moving out, I'm receiving cash from it. That is a very good example of double entry. That is a very good example of double entry. Note this, double entry concept says that For every business transaction, two accounts must be affected. One of those two must be recorded on the debit side, the other one on the credit side. We cannot have the two of them being recorded on the debit. We cannot have the two of them being recorded on the credit. If this one is debit, this one is credit. If this one is credit, this one is debit. That is what we mean by the dual aspect of double entry concept or rule of account, which is actually the golden rule. Virginia?
So the to me is faulty and I return it.
Sorry?
What if the pen that you have sold to me is faulty and I return it?
If you return it now, there's somewhere we call return inwards. Do you remember somewhere we called return inwards?
Yes, on the first class.
Yes, when we were talking about the double entry, sorry, source documents and books of original entry.
Yes.
If you return it now, I'm going to come here and open an account called sales returns, and that is where I'm going to record it. That is where I'm going to record it. Sales returns, that is where I'm going to come here and debit. I say that I've received a pen from Virginia for 50. And what will that mean? What will that mean? It simply means that now the cash that I received here from Virginia of 50 shillings, I'm going to give her back. I'm going to give that particular money back to Virginia. So that this cash that I received, when I credit the cash, it simply means that now that cash has been given out. That is what will happen, Virginia. That's all. So,
okay.
So that you can be able to understand this concept very well, because actually we have said it is the golden rule, and we are going to make use of it from now up to when you do your exams. We need to have some rules written down on how do we treat transactions in ledger accounts depending on their categories. Business transactions, they are grouped into assets. And when it comes to assets, increase in an asset, we normally debit. We normally debit that asset account. Like for example, if I buy a motor vehicle, it simply means that the motor vehicles in the business are increasing. I debit the motor vehicle. So here, anytime you acquire an asset, debit that asset. Debit that asset because that asset or those assets are increasing in the business. Debit any asset that you acquire or receive. Debit it, and then anytime you give out an asset, meaning that that asset is decreasing, anytime you give out an asset, you credit that asset out. What do I mean? If, for example, we have an example here that bought a motor vehicle for shillings 1,500,000 by check. That is a transaction. It's a transaction because it has monetary value. So you will come here and say bought a motor vehicle. So the business has received a motor vehicle. Open the motor vehicle account. So that on my right, it is credit. On my left, it is debit. Then you ask yourself a question. What did I give out to receive this asset? I gave out money equivalent to 1,500 and it was paid by check. When you pay by check, it is your cash at bank that is going to reduce. Your cash at bank is the one that is going to reduce. So you come here and open the bank account. And say that on my left is the DR, on my right is the CR. So you have got your two accounts that will be affected by this statement. Now, the question or what you need to now understand, which one of the two will be debited and which one will be credited? Because both cannot be debited, both cannot be credited. So What you need now to understand is that what you received should be debited. What you received should be debited because whatever you received in the business, those items are increasing. If you had one motor vehicle, now there will be two. If you had none, now there is one. At least they are increasing. Whenever an asset is increasing in the business, debit that asset. You will come here and we normally use the name of the other account, how you acquired it. Right here, bank, 1,500,000 on the debit. When an asset is debited, it simply means that this asset, by the name of that account, that asset is increasing. Like that. Now the other account, which is for bank, it is actually going to be credited. And the reason why we are crediting, because that is also an asset. The money in our bank account is an asset, but that asset is decreasing because we are spending. We are spending that money to acquire a motor vehicle. So if we had 3M in our bank account, we have now used 1.5 to pay for motor vehicle. So what we shall have there is another 1.5. It has reduced to 1.5. So you come here and you write what you have paid. We have paid the motor vehicle 1,500,000. Let me give you another example here, whereby we are told deposited shillings 50,000 cash into the bank account.
Mwalimu,
Yes.
before we proceed,
Yes.
something is not clear to me.
Yes.
We have credited 1.5 million. We have debited 1.5 million, but yet we haven't received it. It has left our account. Should we not like debit the vehicle that we have and credit the money that we've lost?
Come again, kindly.
I can see
Yes.
we have debited.
Yes.
We have the 1.5, yet it has left our account.
Okay. I want us to maybe I clarify at that point before you go back. Now, the question I will ask you, which account have we debited? The account that we have debited is known as what?
Motor vehicle.
Vehicle. Why have we debited the motor vehicle? Because we have acquired a motor vehicle. Are we together?
Oh, okay.
We have acquired. So you look at the title. Don't focus on what we have written here. Focus on the title of that account. The title of this account is motor vehicle account. So we have debited this motor vehicle account because we have acquired it. That motor vehicle has now moved into our business.
Okay.
And now, when you go to the other account is known as bank account. The other account is known as bank account. The bank account, we have recorded it on the credit because that account is reducing. That is actually an asset, yes, but that asset is reducing. That's why we are considering this rule. Decrease in asset is done what? Credited. So you credit the account name. So we go to bank account and we credit. So the moment I look at it like this, even without this information, if I'm just presented with this account and this account minus that information, I can comfortably say so. I can comfortably say that motor vehicle account has been debited, meaning that that motor vehicle has been acquired and it was financed by money in the bank. It was financed by money in the bank. So if I look at the bank account and it is on the credit, I just first of all know that that is money moving out, and it moved out to pay this.
Motor vehicle.
Yes.
Okay. Thank you.
Okay. This is another example too, talking about deposited 50,000 cash into the bank. Cash and bank are both assets. But if you look at that statement clearly, one of the assets is giving out whereas the other asset is receiving. And in that case, the bank is the one that is receiving because this money was in cash, but now it is being deposited into the bank. The bank is already here. There is no need for me to open another bank account because I already have bank account here. What I'll come and do is to open the cash account because I don't have. And how am I going to record it? So deposited 50,000 cash into the bank. So the bank is receiving this money. Bank being an asset, it is going to be increasing. I'm going to deposit an additional 50,000 there. So the balance that I had there will be increasing by 50,000. So I'll come here and debit, and I will write where the money is coming from. The money is coming from cash, 50,000. So you focus on the title of the account. The bank account debited because it is an increase, that money is coming from cash. What about cash? Cash is giving out. It is an asset, yes, but this asset is reducing. It is giving out. You write where the money is going. It is going to the bank, 50,000. You have done a debit and a credit entry for that transaction, and that is what we refer as a double entry. Double entry. For assets, when you receive an asset, debit the asset account. When you give out an asset, you credit the asset account, the one that you are giving out. So your focus should be on the titles of the accounts. Don't look at what you have written here. Don't look at what you have written here. Look at the motor vehicle. If you have acquired, debit, and then you say how it was financed. If it is a cash that was paid out or bank that was paid out, they are supposed to be credited. So anytime we shall be debiting an asset account, be it cash, just know that cash is received. If it is bank, money in the bank is received in form of a check. If, for example, it is a motor vehicle has been bought. If it is a furniture has been bought. Anytime you debit them, it simply means that that item has been acquired. You credit when you are giving out that asset. That is on assets, number one. Number two, we have got this item we call capital or the owner's equity. The owner's equity. So increase in capital we normally record it on the credit side. Decrease in capital, we normally record it on the DR side. It's the opposite of assets. It's the opposite of asset. Capital. We have talked about liabilities in our just concluded discussion. Liabilities are the debts that the business owes the outsiders. And when we were talking about the accounting principles and concepts, there's somewhere we talked about the business entity concept. Under the business entity concept or principle, we said that the owner and the business, they are normally treated as two completely separate entities. The owner and the business are considered as two completely separate entities. The owner's transactions cannot be mixed with the business transactions. Now, you need to have this in mind therefore that the capital was brought in by the owner into the business. Initially, the business had no capital until when the owner brought in some capital. That is when the business started operating. Now, this capital that the owner brought to the business, from the word go, that capital, the business owes the owner. Actually, we normally say that, yes, it is money brought into the business, but because the owner and the business are two different entities, so it's like the owner has lent the business his own money. Even you, when you want to start a business, you are going to give that business capital. But that business that you have started, it is going to owe you. It is going to owe you that amount of money in the long run. In the long run, actually, even though we don't want the business to refund you that money, but in the moment you want to stop that business, the business should give you your initial capital back, so that you and the business are not the same. So from the word go, just know that capital, yes, it is the owner's contribution, but this owner has lent this money to the business for a very, very, very long period of time. For a very, very, very long period of time, which we don't know when, as per the explanation we gave under the going. So capital, when it is increasing, we normally record it. It is the opposite of asset. We normally record it on the credit side.
Mwalimu, you're sounding very far.
Very far.
Yeah.
Oh, let me check my volume. Okay. So the capital being the owner's equity, when it is being brought into the business, we normally record it on the credit side of capital account. By any chance, if we want to take your capital back, we shall debit that account. We shall debit that account. Like, for example, AJ, we have a transaction like that. Started a business with 250,000 shillings in cash. Anytime you will hear this statement, started a business, just know that capital is being introduced. Capital is being introduced into the business. Therefore, open capital account. Open your capital account like that. And the capital, when it is being introduced, it is increasing. Initially, the business had no capital. It had zero capital. That's why the business was not existing. So when the owner pumps in capital into the business, capital is increasing. So you need to come here and record it on the CR side. Come here and you say, yes, capital is increasing the business, so I should credit. And this capital is coming in form of what? Cash. So you say cash, or capital in form of cash is being introduced to 50,000. Then you go ahead and open the cash account. Remember, cash account is an asset. So being an asset, remember the owner has come and deposited that money in the cash box. So the cash account will be increasing. It had none, or it had zero cash, but now the owner has come, opened the business cash box, deposited the 250,000 there to be used to start the business. So you will come here and debit this, and you write here, cash is coming in form of capital, 50,000. So anytime capital is being introduced into the business, capital is being introduced to the business, you will have to open the capital account. Anywhere you are told started a business. And remember, capital can come in form of two ways, actually in form of three ways. One way can be through cash, as we have done here. We can also have capital deposited in the bank, so we shall come here. If it was capital in the bank, we could have done this. We could have come to the bank account and debited the bank account. If it was deposited in the bank, this is what we could have done. We could have debited bank account. And in some cases, the owner can bring in capital in form of a fixed asset or a non-current asset. The owner can decide to bring in the personal furniture into the business. So what you do, you open that asset account. it is very common. You can be told that the owner brought his personal table or furniture into the business. So in that case, you are supposed to come here and open your furniture account and just debit it by capital. Maybe it was a furniture of 10,000. So whenever the owner is bringing in, sorry, there was some reflection there. And you come here and you say capital. Maybe it was a furniture valued at 10,000. So you write it on that. So the owner can bring capital in the form of cash. So you debit cash. Can you deposit that money in the business bank account? So debit bank account. Can also bring in capital in form of an asset. You debit that asset. You debit that asset by the value of the asset that has been brought into the business by the owner. So capital, anytime, most of the transactions that you get in your exams, you are going to started a business with a certain amount of money, either in form of cash or in form of bank. Or sometimes you can be told started a business with 50,000 in cash and 500,000 in bank. That's possible, something like that. Started business with 250,000 in cash and 500,000 in the bank. So you could have done 250,000, and this one we could have now recorded 500. And you are done with that transaction. And then the capital that you are going to write here, capital, cash to 50,000, and then you also write here bank 500,000. That is how it would have been recorded. The capital, part of it is in cash, part of it in the bank. The one that is in cash, you must record it in the cash account. The one that is in the bank, record it in the bank account. Like that. Somebody to ask me a question? Come again?
For this furniture account,
yes,
what is the corresponding credit account?
It is capital. It's capital. If the owner brings in furniture, you will come here and you write here what? The furniture is increasing, you write here 10,000. So capital will always be credited in all the three scenarios, whether it is in cash or bank or furniture. In all cases, we credit capital because capital will be increasing. Then we shall be debiting either cash, bank, or furniture. Is it okay?
Yes, it's okay.
It is okay. Now we'll go to the next category. That was number 2. Category number 3 of items are those items we call liabilities. Liabilities. Remember, I told you liabilities are simply debts. We normally treat them the same way with the capital. Capital and liability, even from the accounting equation, assets is equal to capital plus liabilities. These two are on one side of the equal sign. So we normally treat them the same way. So increase in liabilities we normally record on the credit the same way we did here, and then a decrease.
Sorry, Mwalimu, we treat it as liability, we treat it as assets, or we treat it as capital?
Capital. Actually, they are treated the same way. Increase
As
in
capital.
capital. Yes.
Okay.
Increase in capital, we credit. Also, increase in liabilities, we also credit. Decrease in capital, we debit. Decrease in liabilities, we also debit. So remember, liabilities are debts. They are debts. Like, for example, you can be told, borrowed shillings, 700,000 as loan from bank. Borrowed 700,000 shillings as loan from the bank. So you will realize that one from the bank, let me include this in form of check. Or let me write here, and received a check. So you go and borrow a certain amount of money from your bank account or from your bank. Yes, two things will be happening. One, you will be receiving a check, so your bank balance will be increasing because that check will be deposited there. Bank account will receive that check, even though it is a loan. Therefore, we have come here and record here bank loan. That money is increasing in form of bank loan, 700,000. We shall debit bank. Even if yes, it's a loan, we are receiving money. Then we shall have another account we call the bank loan. The bank loan account. This is now the liability account. This is now going to be our liability account. And when we borrowed this money, we are creating a liability. We are creating a debt towards this bank. So you'll come here and record it on the credit. You'll come here and you say that this money was paid or received by, or was received in our bank, was received in our bank, 700,000. But it is on the credit side. The credit here simply means that there is a liability that we need to pay, a liability that we need to pay, a debt that we need to pay. You debit, yes, it is. Remember we said, when you are creating a liability, there is an asset that you will be receiving. There is an asset that you will be receiving. You cannot create a liability and you don't get anything. So whatever you receive is going to be an asset. In this case, we have received money in our bank. That is an asset that we have received. But we have what? Created a liability. So the liability account is the loan. The loan is the liability. We credit it. But we debit what we have received. We debit what we have received. We shall do this one in details now in our next class. From liabilities, we have got items we call expenses.
Question?
Yes.
Assume this question was framed like this.
Yes.
Borrowed 700,000 from a bank to start a business.
Borrowed
700,000. Yes. From bank as loan to start a business and was paid in using a check. But it was issued with a check.
So you borrowed money to start the business, and it was received in form of a check.
A check. Yes.
Now the question I will ask there: do we have capital first? We have capital account being affected.
Yes.
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 Yeah, borrowing to increase the capital.
It's a credit on the capital account, right? And then the bank account, it's.
No, we debit the bank account. We credit the bank account.
The only question there, look at that.
The capital account is credit. The credit goes to the capital account because increase in capital is recorded. We record it on the credit side. Okay, this is actually the position. From the definition that we have given before, it is owner's equity. What the owner has contributed to business. What the owner has contributed to business. So in short,
when you cannot borrow to start the business. Even if you are going to borrow to start the business, you must have, first of all, your own capital. Even if it is going to be very little, you start with it, you call it the owner's equity. And then from there, after a very short period of time, now you can be able to borrow. So anything that you borrow to come and start capital, to come and start a business, you cannot record it as a capital because it is not owner's equity. Owner's equity simply means that the owner's contribution towards the business. So in that case, from the question that has just been read, borrowed 700,000, it cannot be to start the business, but you can borrow to be used in the business. You can borrow to be used in the business, but at that point you are borrowing, already capital has been captured in the books of account of that particular business. So that already capital is there. Now you bring in a loan or something like that. Now it continues. But capital, it is not normally borrowed. It is normally owner's equity, the owner's contribution towards the business. So you can start even with your 10,000 today, and then tomorrow now you borrow. Now that one, it is going to balance. But the moment you borrow and that, remember, you have a liability that need to be credited, the capital that need to be credited, but you only have the bank which will be debited. So we are going to have these two, though we can have them, but we cannot have at the point of starting the business. We cannot have them at the point of starting the business. That's all. Pump the little. Yes. Yes, somebody is saying something.
So, Mwalimu,
Yes.
from that question,
Yes.
which accounts are affected?
If you read the way the question was framed by our friend, you know, first of all, there's an issue of borrowed. The moment you borrow, then we shall have the bankroll. This is where we have borrowed from. Then we have borrowed that money to come and start the business. Anytime you come and start the business, we are supposed to come and open the capital account. That loan has been received in the business in the bank because we received a check towards that. So we shall debit this one because this is the only debit entry that we are going to have. So it's going to be like this. But I've said this, we don't borrow to start the business immediately. The issue is before the business can actually continue, first of all, you must have your own small amount, first of all, being introduced, which is capital, and this one may be bank. Then even if it is the next day, now you can go and borrow this loan, and then now we can capture the loan and the bank. But you cannot borrow, and then that one is your capital. No, capital must start, which is your own, whatever that you have given the business from your own pocket or from your own account or savings. If that one is not enough, now you can resort to the borrowings later on, but not the same day the business is starting. Okay. Well. I was talking about item number 4, known as the expenses. These are the costs of running the business, apart from the cost of inventory and the cost that you are going to incur in buying the fixed assets. The cost of the fixed assets and inventory, they are not expenses, but all the other costs that are going to be incurred in the process of running the business, they include rent, insurance, salaries and wages. We also have what? Cleaning, repairs, all those. The costs that are incurred, the operating costs of running a business, they are normally considered as expenses. when we pay these expenses, when paying expenses, debit respective expense account, credit, cash, or bank. One thing that you need to appreciate is that you are paying. Anytime you are paying, either cash or bank will be reducing. When an asset is reducing, it is always credited. When an asset is reducing, it's going to be credited. You are paying the expenses, always credit either cash or bank, depending on how you are paid. Like, for example, if e.g. paid salaries of shillings 80,000 by cash, how are you going to record that? You need to come here and open the salaries account. That's why we are saying respective expense account. And then you debit that expense account. You come here and you say that it has been paid by cash, 80. Then you open your cash account. And you say that anytime I'm crediting my cash account, money is moving out. You write here what you have paid. The salaries of 80,000. So you are going to pay, you credit the salary, the cash, because it is money out. Anytime you credit cash or bank, you just know that it is money out. Then what you are paying, which is the salaries, you debit that. If we have another one here, paid rent of shillings 25,000 by check. The expense that you have paid is rent. The expense that you have paid is rent. So just come here, open your rent account. You debit it. You debit that respective rent account. You come here and you say it is by check. Anytime we talk about check, that is simply affecting the bank. Then go ahead and open your bank account. That is money out. So you credit your bank account by rent. By rent. So always we shall be debiting the expenses. If it is insurance, debit insurance, credit bank. If it is repairs, debit repairs, credit bank. If it is by check. If it is by cash, we shall be crediting cash account. So when paying expenses, debit the particular expense. Don't open an expense account. We don't have a common account for all of them. Each expense with its own account. So that's why I said here respective expense account. Each expense on its own account. And then you credit either cash or bank. And then I want to talk about one more item, then we shall conclude. We have got what we call revenues or incomes. Okay. These are the sources of income. They include sales, discount received, rent received, interest, dividends, commission, all of these ones we normally consider them as revenues, sources of income, sources of income, sources of income. when revenue is received, debit. Remember, revenue is money coming in. When it is now coming in, debit cash or bank. Remember, we said cash or bank. Anytime we receive it, you debit. But anytime you pay, you credit. So you pay, you debit cash or bank, then you credit revenue or respective. The respective revenue account. If it is goods sold, we shall debit. Sold on cash, we shall come here, debit cash. By sales, maybe it was 10 or 1,000. Goods sold, or we sold goods 1,000 by cash. We debit cash, then we shall proceed here and open the sales account. This is now the respective revenue account. Then we credit here by cash. We debit this one. We credit this one. So revenues are always going to be credited, and then we debit either cash or bank because it is going to mean money is being received. Anytime money is received, we debit cash or bank accounts. I want to stop there. Under the old curriculum, we have a class tomorrow. We shall do the examples that I shared with you. The old curriculum, tomorrow, Monday, we have a class with you at the evening. We are going to do an example on all this. For the new curriculum, we shall be meeting on our usual class on Thursday early morning. We also do the same with you. So now, from there, we shall meet in our.
Excuse me, Mali.
Yes.
Yes. Excuse me.
Yes. Go ahead.
Yes. Can you say we haven't received the link for the old curriculum WhatsApp group, please?
There was no link that was shared in the WhatsApp.
They indicated it's a new curriculum.
Oh, but we are using the same link.
Oh, okay. WhatsApp group, the same WhatsApp group, right?
No. We have two different WhatsApp groups.
Maybe the class rep can help us.
Yes. For which group? The new or the old curriculum?
The old curriculum WhatsApp group.
The old.
Yeah.
I'm wondering.
But
I'm wondering what's the difference between you and old.
Just a minute.